When you buy a house, insurance feels like a simple transaction. You pay a monthly premium, and if a covered disaster damages your home, the insurer helps pay to repair or rebuild it. But underneath that simple transaction is a much larger financial mechanism. Insurance works because millions of homeowners pay into a shared system where most of them don't need the money at the same time. The entire system rests on a diversified pool, spreading risk across space, time, and thousands of separate properties. In any given year, a small fraction of homes suffer severe damage, while the vast majority suffer no loss at all. Premiums from the many cover the claims of the few, absorbing losses without straining the system's capital. When losses remain sufficiently diversified across the pool, insurers can spread those costs and keep the system financially manageable. Insurers can set rates, maintain required reserves, and operate a predictable business model. The problem begins when a changing climate alters the underlying risk of physical hazards. When a single catastrophe impacts thousands of assets at once, losses shift from diversified to concentrated. The insurer is no longer paying claims to a tiny fraction of its customers, it is paying an entire region simultaneously. Regional disasters have always produced correlated losses. An individual hurricane or wildfire was never a surprise to underwriters. What is changing is the climate risk environment insurers have to price. In some places, certain hazards are becoming more frequent, more severe, or harder to predict. And you can already see this strain playing out across parts of the American insurance market. But shifting climate dynamics are only one part of the financial equation. The second critical driver is asset concentration and human geography. Over recent decades, millions of homes have been built directly in highly exposed geographic corridors. At the same time, property values, building footprints, and replacement costs have grown substantially. When you multiply changing physical hazards by higher asset values and rebuilding inflation, potential losses compound. The same storm path today encounters vastly more property value than it did 40 years ago. Look at how this interaction between climate risk and asset value plays out in California. Severe fire seasons repeatedly destroyed entire neighborhoods, producing historic insured losses. It wasn't simply a story about insurers refusing to cover losses. Physical risk, asset exposure, and rebuilding inflation collided with reinsurance costs and state regulatory structures. California's regulatory framework has historically made it harder for insurers to incorporate some forward-looking catastrophe risk into their pricing. As these costs surged, primary carriers faced shrinking underwriting margins in high-risk zones. But California is now changing those rules to allow forward-looking risk models. And that reveals something important. Insurance systems can adapt, but adapting the price of risk doesn't make the physical hazard disappear. In Florida, climate exposure combined with human systems to show a very different side of the same problem. Florida's market was shaped not only by storm exposure, but also by years of elevated litigation and disputes over claims and repair costs, including disputes that once centered heavily on assignment of benefits claims. When claims become more expensive to resolve in court, insurers face a higher cost per loss, even before accounting for the physical damage itself. As several local domestic carriers faced insolvency, private coverage options contracted rapidly. Many homeowners turned to Citizens Property Insurance Corporation, the state's insurer of last resort. When private insurers retreat, state-backed programs step in to keep property coverage available. But public programs do not eliminate the underlying climate hazard or lower the cost of rebuilding. They shift more of the financial exposure onto public mechanisms and broader policyholder assessments. So when we say climate change is breaking insurance, what does that actually mean? It doesn't mean insurance companies are disappearing everywhere overnight. It means that in high-risk zones, the traditional relationship between physical risk, premium pricing, capital, and coverage is becoming harder to maintain. As climate hazards intensify, the old price of protection no longer matches the true uncertainty of the risk. Insurers respond by raising prices, restricting policies, seeking more capital, or leaving exposed markets altogether. This raises an obvious question. Why don't insurers simply charge more and keep writing policies? If climate risk doubles the danger in an area, why not double the premium? In theory, higher prices allow insurers to charge more for higher expected losses. But in practice, insurance pricing is heavily regulated. Consumers need affordable housing costs. Insurers need rates that reflect expected climate losses. Regulators must balance both. To raise rates significantly, an insurer must submit complex actuarial filings, which can take months or years to approve. If approved rates stay below what insurers' catastrophe models and actuarial analysis indicate, is needed to cover expected losses and capital costs. Writing new policies risks severe capital losses. Rather than risking insolvency, insurers choose to limit their exposure and exit vulnerable areas. This connects directly to global reinsurance and why international capital affects local homeowners. A local insurer doesn't keep enough cash on hand to rebuild an entire region after a major climate event. To remain solvent, primary insurers buy their own insurance from global reinsurers. Reinsurers pool risk globally, diversifying exposure across different regions and perils. After major catastrophe losses and shifts in the global risk environment, reinsurers may raise the price of catastrophe capital. Because local insurers rely on reinsurance to manage extreme losses, higher reinsurance costs can feed into local insurance rates. Even if your house never suffers a claim, rising catastrophe capital costs can still become one reason your policy gets more expensive. But if rising climate risk makes insurance harder to get, why do people keep living in exposed places? Why doesn't population simply move away as physical hazards escalate? Because human civilization does not relocate overnight. People remain because that is where the jobs are, where families built roots, and where land was affordable. Cities, local tax bases, and millions of existing homes cannot be quickly packed up and moved. Physical geography changes slowly, human settlement changes gradually, but financial markets reprice almost instantly. Insurance doesn't force immediate migration. It attaches a dynamic price tag to staying in a changing environment. This distinction highlights a fundamental truth. Insurance does not reduce the physical hazard itself. A seawall, a fire-resistant roof, or a cleared defensible space physically stops damage from happening. Insurance transfers and prices some of the financial consequences when damage occurs. When physical risk is reduced at the property level, insurance becomes easier to price and finance. But site-level adaptation involves complex economic trade-offs that communities and regulators must navigate. Pure risk-based pricing reflects true climate hazards, but can make housing unaffordable in exposed areas. Suppressing rates keeps housing accessible short-term, but obscures the growing physical risk underneath. Sometimes, rising insurance premiums are simply the market signaling that a risk is getting harder to spread. Insurance isn't the wall holding back climate risk, it's the price tag attached to physical reality. And when that price tag changes fast enough, the signal reaches the rest of the financial system. Property insurance is an invisible structural pillar sitting directly underneath the mortgage market. For most conventional home loans, lenders require active property insurance to protect their collateral. In high-risk markets, buying and selling homes can become much more difficult if coverage vanishes. When annual insurance costs spike by thousands of dollars, they can materially reduce what a homebuyer can afford. Over time, real estate markets begin pricing properties not just on location, but on underwriting risk. To understand where this is heading, look at a fundamental mismatch in time horizons. Property insurance adjusts relatively quickly because it typically renews every single year. If climate risk shifts, underwriters can reprice or exit a market 12 months later. But residential mortgages do not work that way. A 30-year mortgage ties financing to the property for decades. And much of the physical infrastructure beneath modern cities is designed around multi-decade lifetimes. This creates a structural blind spot. Long-term credit and infrastructure are anchored in places where short-term risk capital is retreating. The physical world can change much faster than the long-term financial contracts built on top of it. A homebuyer signs a 30-year mortgage assuming the property's financial foundation remains stable. But if primary insurers reevaluate what risk they can absorb on a one-year contract, the real question isn't just whether your insurer will renew your policy next year. The question is, what happens when mortgage lenders start doing the exact same math and begin reevaluating whether lending against 30-year assets in high-risk zones is still safe? Because when insurance starts repricing physical reality, the next system that has to respond is credit.